I now hand the conference over to Mr. Anup Pujari from CDR India. Thank you, and over to you, sir.
Thank you. Good afternoon, everyone, and thank you for joining us on Lemon Tree Hotels Q3FY21 earnings conference call. We have with us today Mr. Patanjali Keswani, Chairman and Managing Director, Mr. Ratan Keswani, Deputy Managing Director, Mr. Kapil Sharma, Chief Financial Officer, and Mr. Vikramjit Singh, President of the company. We will begin the call with brief opening remarks from the management, following which we'll have the forum open for an interactive question and answer session. Before we start, I would like to point out that some statements made in today's call may be forward-looking in nature, and a disclaimer to this effect has been included in the results presentation that was shared with you earlier. I will now request Mr. Keswani to make his opening remarks.
Thank you. Good afternoon, and thank you everybody for joining us on this call. I hope everybody is safe and healthy during this trying period of the pandemic. I guess the good news for all of us is that we are now seeing less than 12,000 COVID cases a day, and our country also has not been any second wave yet, unlike the US and many other European countries. At the same time, the vaccination is progressing, play a crucial role not only in our fight against the pandemic but also in reviving the broader economic sentiments over the next few quarters. In the quarter gone by, our revenue from operations stood at 68.4 crores versus 199.6 crores during the same period last year. Our revenue in Q3 increased 43.7% on a Q1Q basis from 47.6 crores in Q2 FY21. Our total operating expenses, including corporate expenses, came down by about 59% to 48.3 crores in this quarter, from rupees 118.3 crores in Q3 FY20. However, there was a 23% increase in our operating expenses in Q3 versus Q2, which was on account of higher inventory being operational in Q3 as compared to Q2 and better occupancies in our operational hotels. Out of our 5,200 owned/leased hotel rooms, 4,736 rooms were operational on an average in Q3, which were 5% higher than the number of rooms operational in Q2. Our occupancy in operational hotels expanded by 926 bps from 37.3% in Q2 to 46.5% in Q3. We recorded a positive net EBITDA of 22.3 crores in Q3, which was 73.5% lower than the 84.4 crores in Q3 FY20. But our net EBITDA in Q3 was about 55.8% higher than the 14.3 crores in Q2. Our net EBITDA without other income was in fact 141.7% higher in Q3 than in Q2. Our EBITDA margins also showed a significant improvement in Q3 over Q2 by expanding 1,191 bps to 29.4% in Q3 from 17.5% in Q2. Our focus on our operating cost model throughout the past 3 quarters has now started to reap fruits for us in the form of sequential EBITDA margin expansion. In fact, as I said earlier as well, let me re-emphasize that many of these cost optimization measures will be permanent in nature, which we expect will lead to a minimum net EBITDA margin expansion of 500 going up to 700 bps when things get back to normal. While we continue to explore and experiment with leaner operational practices to achieve operational excellence, we are also totally committed to uphold best-in-class service standards. Once again, in the quarter gone by, our business mix was dominated by demand from retail channels. I would like to mention that in Q3 FY21, the total number of room nights from the retail segment was 11% higher than the number of room nights in the pre-COVID period of Q3 FY20. We saw a significant pickup on quarter-on-quarter basis in demand from the corporate segment as well. The number of room nights in the corporate segment increased by more than 90% in Q3 21 over the previous quarter. From the liquidity perspective, it is now extremely unlikely that we will avail of our 2 pre-approved fundraising options, which was the rights issue of 150 crores in Lemon Tree and the call for raising the second tranche of rupees 125 crores from ABG. As of now, we have sufficient cash to service our debt obligations and to fund our under development project. for the next 6 quarters, even in the worst case scenario, although we believe that the worst is clearly behind us now. We continue to be absolutely vigilant in ensuring the safety of our guests and employees. The SOP is covering all aspects involving our guests, employees, vendor partners, which we implemented in Q1, continue to be in place. We're also working on a plan to get our hotels as well as our corporate staff vaccinated. To summarize, we are positive about what lies ahead for us in the future. We're also pretty sure that the rebound in the hospitality industry will gain momentum in the coming quarter as the fear of the virus allays, and incidentally, as is already evident in Q4. We are confident that our fundamentally strong business model, significant liquidity, and our established brand will help us successfully weather these challenging times. And we will come out as a much more efficient company than before. So on that note, I come to the end of the opening remarks and would now like to ask the moderator to open the line for Q&A. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may please press star, then 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star, then 2. Participants are requested to use handsets while asking a question. Anyone who wishes to ask questions, please press star, then 1. The first question is from the line of Archana Gude from IDBI Capital. Please go ahead.
Hi, sir. Thank you for the opportunity. I have 3 questions from my side. Firstly, so if I see our ADR trend for last 3 quarters, there has been significant variation wherein we saw improvement in August, and then again there was dip in October, and then again the trend was upward. Should we attribute this to the new hotel opening where the ADR was lower, or which might have dragged the overall performance? And also, was it due to the discounts offered? Some color on the ADR part, sir.
So Archana, basically, you see our normal mix. So let's talk about ADR pre-COVID and during COVID. So in our normal mix, our ADR, as you would have seen, is well north of 4,000 bucks. What happened in COVID was that what we call the traditional business or non-COVID business disappeared. So in fact, from Q1 onwards, while COVID-related business has been steadily reducing, it has been the dominating factor in Q1 and Q2 in determining our ADR because it is more than 50% of our total business. Gradually, over the last 3 quarters and the next 5 quarters, in my opinion, obviously COVID is going to get to zero demand from the COVID segment. The non-traditional will be gradually replaced with different segments coming, into our operating business mix at different times. At present, because there is not enough demand from traditional sources, there is a lot of discounting going on across India in the retail segment. So the real reason for the fall in ADR is no longer COVID, because COVID today is maybe 5% of our total demand. That remaining 95%, most of it is retail, and most of it is coming at much lower rates than normal. Now, when will this go? So broadly, so if you look at the industry and look at Q3, and I'm giving you just a broad example, you will notice on a broad basis that fall in all the 4 listed players in Q3 this year versus Q3 the previous year is in income is roughly 60 to 70%, which means today in Q3 the hotels did income of 30 to 40% of what they did in the previous year. All of that is driven by retail. And while the listed universe is obviously a much smaller segment, overall in the hotel business you will find heavy discounting because the replacement segments or all the segments have not come back. Broadly, my expectation is, based on what I'm seeing in Q4, is that Q4 will be, like I said, that the fall in income, and this is not about Lemon Tree, this is about the industry. The fall in income is, 30 to 40% 40 to 30 to 40% is the new income levels compared to the previous levels. In Q4, my guess is this will now expand. So the industry will probably be 45% of Q4 of last year. Just like today it is 30 to 40, there will be a significant expansion in revenue in Q4. Therefore, you will see a small uptick in ADR. Q1, Q2 next year, my guess is will be catch-up months because large corporate travel will also start. My best estimate is that H2 next year is when ADR will catch up. Because first, you have to keep in mind, occupancy has to catch up. Did I make sense to you?
Right, sir. Got it, sir. That was it.
Yeah, because capacity utilization leads to price increase, not the other way around.
Right. So just to follow up on that, you spoke about the corporate travel. So have the corporate contracts have come for the renewals and maybe some trend on pricing there?
So well, in our case specifically, we did not renew the prices. Obviously, we normally corporate pricing changes on effective 1st October and 1st January. Last year or the year gone by, in 2020, we did not change our pricing, but that was a moot point because there was no corporate demand. But so suffice to say, our rates, our corporate rates are still the same as they were in, say, last quarter of 2019, calendar 2019, which is when our prices changed last. And we do not expect to change our pricing in the coming October, and we expect to continue with the old pricing.
Sure, sir. And so lastly, if you just throw some light on the performance of the key cities for us.
Okay, so I guess it's there in one presentation, in our investor presentation. Let me just get there. So if you find in the key cities like Delhi, these are cities where we have significant owned assets. So we are, as you know, we have more business hotels, less pleasure hotels than the other large listed players. So in Delhi, we have 640 rooms. So our occupancy in Q3FY20 was 85%, it dropped to 55%. Gurgaon, which is, you see, Delhi had one advantage. It has multiple types of users, including guys coming in as, you know, from due to the airport and so on. Gurgaon, which is heavily large corporate dependent, and there we have over 500 rooms owned, dropped from 75 to 30% occupancy. Hyderabad, which again has multiple sources of demand, though it is largely dependent on IT, dropped from 77% in Q3 to 45% in this quarter. Bangalore, where we have very large inventory, close to 900 rooms, dropped from 65 to 24, because that is the most IT dependent in India. Mumbai, where we currently have 300 rooms, was very resilient. From 62%, it dropped to 59%. And today, in fact, it is at 80%. So there are certain markets that will bounce back first. For example, I reckon that Bombay, Delhi, Hyderabad will bounce, followed by Bangalore and Gurgaon. So the IT sector, I expect, will really come back into play in this coming quarter, Q1.
Sure. So is it fair to assume that we are at least 2 to 3 quarters away to get back to our earlier occupancy levels?
Okay, so let's put it this way. I will repeat. Q3, as we see, from an income perspective, because some listed players do not report ADR and occupancy, so I guess I can't take that as an aggregate. But let me just broadly say that Q3, the income was 35 to 40% of Q3 of the previous quarter. My expectation is in Q4, again speaking for the industry, the income will be 45% of the previous Q4, which means really an expansion of 25-30% in revenue. Going forward, my broad expectation is in H1, our income will hit in a staggered basis. It will go up to 60 to, depending on the player, 60 to pre-COVID.
Sure, sir.
Okay, this all depends on when the corporate travel starts and how effectively we vaccinate people. Okay?
Sure.
I have
Thank
no
you so
doubt
much.
that H2 we will catch up.
Right, sir. Yeah. So thank you so much and all the best.
Thank you.
Thank you. The next question is from the line of Nihal Jam from Edelweiss. Please go ahead.
Yes, thank you so much and good afternoon to the entire management. Sir, 3 questions from my side.
Excuse me, this is the operator. I'm sorry to interrupt. Nihal, your voice is not clear. Maybe the
Sorry, is it clear now?
Yes, it is. Thank you.
Sure. So 3 questions from my side. In our last quarter discussion, you had given a little more clarity on how demand on a per room night basis was progressing. And if I remember right, it was, I think, around 300 room nights from COVID, whereas the retail segment was around 1,200 room nights. Is it possible to give a sense that currently how is that number breaking up in total?
Okay, so Q2 I think we did about 1680 rooms a day. 950 were COVID and 730 were non-COVID.
Yes.
In Q3, this 950 COVID dropped to 240. And non-COVID went up from 730 to 1960. Which means basically non-COVID grew about 2.7x. Now, what is happening in Q4? COVID is less than 100. So, Q2 COVID was 950, Q3 240, now it's less than 100. What's happening on the non-COVID? It was 730 in Q2, 1960 in Q3. It is north of 2600 today. So what I'm really saying is that our occupancy is north of 2700. And which is over 50% of our inventory. But COVID is like under 5%. And I genuinely think it will become zero in another 1.5 months. So that's what I'm seeing happening. Now, because of this, there is some improvement in pricing also because the non-COVID segments that are coming back, some of them have higher pricing. So the mix is changing. But this impact will be, while it will be visible in Q4, it will be most visible in Q1 and Q2 next year, especially because there are other things happening like, it's wedding season and so on and so forth. So broad guess, hotels will do anywhere from 40 to 50% of pre-COVID revenues in this quarter, probably 45 to 50. And then from the next quarter, they will start getting into 65, 70, 75% of pre-COVID. And I have no doubt that Q3, it will be fully pre-COVID.
That's very helpful, sir. So just a related question on that, as you're giving the progression of how you expect occupancy to improve and potentially in H2 of next year, we would be in excess of, say, 75 to 80% occupancy on an average. In that scenario,
I'm not saying that, Nihal. I'm saying we will be back to pre-COVID levels of occupancy. I don't think it was 75 in Q4. In Q3, it was higher in Q4 because in Q3, Diwali had got and normally does bring the occupancy down. So whatever the number is, we'll be close to that.
Absolutely. The point is that in that scenario, once you see that the base fills up, do you think the industry would be at a position where you can take your ADRs to the in a range of what it was pre-COVID, or that you think will be another gradual ramp up over the next 6 to 12 months?
No, it will be an instant ramp up. Because you keep in mind, I'll tell you why. Because this is an interesting question you asked. So see, different hotel companies have different segments. So take the big 5-star chains. They have large meetings, incentives, conferences, facilities, right? That's wedding business, for example. That will see an instant change.
Sure.
We all have retail segment. My retail segment today has become 1.1 times what it was pre-COVID. That's an amazing number that retail today in Q4 is 1.1 times of Q4 last year. So that's really bounced. That segment is where pricing is instant. It's like the airline segment, seat pricing. Where is price fixed? It is really fixed in contracts. So corporates, travel trade business and so on, which is put together maybe 35-40% of my business, and for most people maybe 40% of their business. So that segment of pricing may remain the same, depending on whether our hotel companies offer new pricing in October. But the 60% which is not fixed, which is dynamic pricing, will shoot. I have no doubt. Because what you are not seeing yet is, you see, demand is still picking up, but supply impairment has not come into play yet. So my broad guess is that on a permanent basis, about 5 to 8% of demand will disappear because of Zoom and so on and so forth. And we have our reasons for taking these numbers. My guess is 15% of supply will disappear. So when you look at that, my best estimate is that for the industry, Q3 will be the quarter when things will come back to normal.
That's very helpful, Mr. Keswani. Just one last question, specifically to Lemon Tree. You mentioned that you have obviously dropped plans of fundraising because internally the cash flows are sufficient, if I understand right. I just wanted a little more understanding on that, because if I look at our performance for December, we are generating a monthly EBITDA of around 12 CR. Whereas the monthly interest, and I know that includes lease also, is around 14-15 CR. So just wanted a sense that in the coming quarter, how will this gap be bridged, and a sense of the cash flow situation in the coming 3 to 6 months, which gives you the confidence of not wanting a fundraise. That's
okay. So firstly, cash, we have about 100 crores plus we have 140 crores, which is that emergency credit line guarantee scheme. So put together, we have about 250 crores of cash. Now, if you look at our P&L, and I will not talk about quarter 4, but I can broadly say quarter 4 is much better than quarter 3. Quarter 3, the real pickup was not in October. It was not in November, because November was significantly affected again due to Diwali being middle of the month. It was in December. In December, if I remember right, we did over 90 lakhs a day in revenue. Okay? Which is roughly 50%, or not 50, 40, 45% of our revenue per day maybe in December last year. Very rough numbers. This trend line is continuing. Now, as far as our expenses go, the expenses are not picking up at the same level, clearly, because what we are finding is, while we are going back to, let's put it this way, a positioning for post-COVID, we find that the permanent disappearance of our cost is roughly 11 lakhs a day. Okay, or about over 40 crores a year. That will be a permanent loss of expense. So obviously some expenses are coming back. That's the broad point I'm making in Q4. Revenue is also improving far more significantly. And if you look at it, therefore, if we are out of pocket 5, 10, 15 crores, 20 crores, if you remember in my opening statement, I said, we are very comfortably positioned for the next 6 quarters, assuming worst case. Worst case is, by the way, not Q4 nor December. Worst case is Q3 in our case. So there is no problem from the cash perspective.
sure, sir. That's helpful. I'll come back in the queue and I wish you all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Amandeep Singh from Ambit Capital. Please go ahead.
Thanks for the opportunity. Sir, the investor presentation talks about gradual recovery from the large corporates. So in that context, can you spend few minutes to give us some sense on the revival of the overall business travel demand and give some clarity if this demand is largely pertaining to project-based group travel or also individual-based business travel?
So I'll talk about Lemon Tree, and I think Lemon Tree, because we are in over 50 cities, is a fairly good proxy for industry. So if you look at our segment, and I'm talking mid-market, 10% of our demand is foreign travel. That won't come back till vaccination, herd immunity, and so on. So in my mind, I'm assuming it will not exist even in financial year 22. That's the assumption we are making. So that 10% is gone, or it will be immaterial. It will be 1 or 2%. Then we have 40% retail on a normal year. We expect this is going to grow to anywhere from 45 to 50. That's what we are seeing happening. So I'm doing apple to apple. The earlier waterfall was retail was 40, 10 was foreign travel, that's 50, 20 was large corporates, that's 70, 25 was small corporates, medium corporates, that's 90, and about 10% was meetings, incentives, conferences, very, very roughly. What I see happening is this 40% is now going to 45 to 50. The 10% foreigner is still very low, so I will not treat it as material. The medium corporates, those are coming back. They are roughly 50% of what they were, which means earlier they were 25, now they might be 10 or 11. Large corporates, 1 out of 25 still. But most have told our sales team that they are going to come back in H1 of this coming year. Meetings, incentives, conferences, which was normally 10, including some leisure in that, today is probably 3 or 4, because it's not that they are not happening, but they are far smaller, conferences and weddings and so on. So if you add this together, then we should be about 55% of 50 to 55% of pre-COVID. But we are seeing a very fast pickup now in small, medium, micro. We are expecting in April onwards a certain pickup in meetings, incentives. Corporates, in our internal planning for the financial year 22, we have assumed will really come back partially in Q2 and entirely in Q3.
Sure, sir. That was really helpful. And sir, my second question is on debt and capex. So while you believe that larger portion of the debt is into the Fleur platform with longer maturity date, can you help us understand debt repayment schedule for FY22 and 23 and annualized capex guidance, as you highlighted that internal cash flows would be sufficient?
Yeah. So firstly, let me talk capex. Then I will ask our CFO to give you an exact number on our debt. Our capex is really towards Mumbai International Airport, right? And 80% of it is for financial year 20, calendar year 22. Because our business is a little weird. The money goes first into building land and the basement, which is a large component, which we have already invested about 350 crores in. And that's all equity. Then there is construction of shell. Shell takes 9 months typically, but shell is like 5 crores a month because you're building the superstructure. Then the finishing and the ordering of equipment, which is in the last 9 months, takes care of another 60% of your project cost. So from that perspective, we do not have very high capex requirements in FY22, which is the coming year. So now I'll ask Kapil. Kapil, can you broadly explain what your repayment schedule is?
Yeah, sure. So for next financial year, FY22, we have the total repayment obligation of 115 CR. So that's the thing for Fleur as well as Lemon Tree taken together, because as you rightly mentioned that Fleur, as you know, most of the many additions were done in FY20, and those loans are newer ones and their initial repayment are lower. So repayment are not that high in the initial period, and that's why it's coming to 115 CR only.
Sure, sir. And you could also highlight for FY23?
Yeah, so FY23 is close to 140.
Sure, sir. That was really helpful. And sir, lastly,
and one thing also I would like to mention that our cost of borrowing has also reduced. So as it was 9.6 as at the beginning of the financial year, current financial year, now it is reduced by 1%. It is now 8.6%.
This is really helpful, sir. And so lastly, on the Hampstead Living JV, so while the entity had aggressive expansion plans pre-COVID, can you help us with your outlook on this segment and guidance of any capital commitment over the next 1 or 2 years, if any?
Nothing. It is right now we are not looking at it because in the middle of COVID, it is when nobody can travel, nobody can. We can't even reach out and So to summarize, it's not on our priority list for this coming year. We will review it once herd immunity, once the vaccine has disappeared.
Sure, sir. That was really helpful, and that's all from my side. And all the best. Thank you.
Thank you.
Thank you. The next question is from the line of Bharat Subramanian from Sundaram Mutual Fund. Please go ahead.
Hello. Good afternoon, sir. Congratulations on a set of good numbers in the tough environment that you're operating. Sir, in terms of the governmental support, to the industry, a lot of things were expected over the time frame, and the government has been talking about supporting, the industries when they open up. So we seem to be, in a position of opening up to travel, etc. at this point. So should we expect any support from the government through any schemes? Are we, as an industry, in discussions with the government, sir?
Well, we have been in discussions. See, I'm also the treasurer of the Hotel Association of India, so I can say from that lens, that cap, that we have interacted extensively with the central and multiple state governments. They have given us an enormous amount of moral support. Unfortunately, there has been no financial support. And my best guess is that we will get no support. However, certain states have been helpful. For example, the Maharashtra government has, as you know, converted our industry into our segment, the hotel business into an industry. So certain benefits were instantly available, which is electricity costs, which were also linked to property taxes and so on and so forth. In an aggregate, it would benefit us by a couple of crores a year in Maharashtra. But most state governments, while they have been supportive, have not been financially supportive. And Bharat, I don't expect it. Frankly, I don't expect it to happen. If it had to happen, it should have happened at least at some level in the budget. But unfortunately, a sector which is nearly 10% of GDP and the most badly impacted has not gotten any direct support. However, if the budget, the way we see it, is the budget is going to lead to some uptick in economic activity. And that in turn will have obviously an indirect benefit for us.
Fine, sir. Sir, and the second point, in terms of, the equity fundraise at different levels that you are planning, sir, is there any change to plans, or would you basically take it as it comes in, depending upon the requirements going forward? Any thoughts on the original plans and how they stack up now?
No, see, if you broadly look at us, our cash out is not significant in every quarter. If you look at cash out in Q3, and as I said, in Q3, October and November were like Q2. It was December that really we moved into the new set of numbers, which have continued into January and February. So at about 1 crore a day income, our cash out is really not significant. It's small numbers, maybe a couple of crores a month or something. So as I said, we are sitting on about 200. How much is it, Kapil, including that emergency credit line guarantee scheme? About 250. Hello.
250 CR.
Yeah, so we're sitting on 250 CR. At the current very depressed level of performance, we are out by a couple of crores a month. So we are, as I mentioned in my opening statement, it is extremely unlikely that we will need that additional 125 crores from APG for Fleur, because as somebody earlier mentioned, Fleur is where maximum debt sits. Nearly 80% of our debt sits in our joint venture with APG. And we are nearly also equally certain that we will not need any rights issue. So that was really a perspective that came in the middle of last year when there was uncertainty about, when will the bounce back start happening. But the bounce back is very clear now in Q4. And with our, even those clients who do not use us today have told us they are going to start from the next quarter.
Sure. Thank you, sir, and wish you all the best.
Thank you, Bharat.
Thank you. The next question is from the line of Sumant Kumar from Motilal Oswal. Please go ahead.
Yeah, hi, sir. So my question is regarding supply side.
Excuse me, this is the operator. I'm sorry to interrupt, Mr. Kumar. May we request you to use your handset, please?
Yeah. So my question is regarding supply. So can you discuss more about how much percentage of supply is likely to go from the market, and if that is the supply is go away from the market, what it is be converted towards that supply?
So let's talk about, I'm talking industry again, before COVID. Let's assume there are 100 rooms and industry occupancy was 70 rooms. 70%. This is industry. Okay, branded hotels, supply and demand in India. On a annualized basis, pre-COVID, for the previous, say, 7-8 years, on an average, every year, demand had grown at 11% a year. Absolute. Supply had grown over 8 years at about 13% a year. So there was a demand-supply imbalance, which is why the industry did not really go through any significant price hikes in the last 7, 8, 10 years. This is the background. Post-COVID, when you look at this demand of 70, I expect a reduction of about 5 permanent, which would be 6% of that 70, which would be fundamentally due to new ways of communicating, like what we had, like Zoom, so on and so forth, and fewer face-to-face meetings. However, a large driver of rooms in India, large corporates have now become a small segment of driver of rooms in India. So I'm just assuming that 70 will become 65. Supply side, that's 100 will definitely not be more than 85. So your new numbers, once things stabilize, will be 68 divided by 85, which is nearly 80% occupancy. That is my estimate. Will start playing out by the next calendar year, and it will lead to fairly significant increase in prices.
Can you discuss more about the 15% of the supply which is not going to be? It is converted to what of commercial spaces, or what it is going to be with the supply?
It may not be converted. It may just be a bad asset, not operating. Like there are plenty of such hotels already. So So listen, you're asking me to really comment on an area where it is still playing out. Really, if you look at it, Suman, you will start getting a picture at the end of this quarter when NPAs start coming in and when banks want to clean up their. If you look at it very broadly, it's evident that the government of India and the Reserve Bank of India are both focused on asset quality reviews and cleaning up, balance sheets of banks. When that happens, one of the results will be the hotels that have been utterly stressed in the last 9-10 months and continue to be stressed for the next few months, they will start popping up. So some of them will obviously change hands. Some will get into disputes and will, not operate only. Difficult for me to say what will happen, but broadly, based on conversations I've had with hotel owners, that distress will become evident now. Because earlier you had a moratorium, you had, very clear government support. But when that all is withdrawn, then the real picture will emerge. So this is a very broad guess. I may be off. But supply destruction will be certain. And I think we will be playing catch-up also because demand growth has always been 11-12%. That should come back into play. Some level of supply destruction and no future growth of supply, I reckon, for the next 4-5 years. because it has been so badly bruised, the industry, that nobody wants to build hotels. So all this should play out at, well, best guess is next year onwards you'll start seeing significant movements in pricing in the hotel sector after 15 years, by the way.
So when we talk about the 15% supply destruction, what segment we are talking about? Majorly in luxury segment?
No. In fact, luxury will be less. It will be in the lower segment, some upper upscale downwards.
Okay, downwards.
Yeah.
So talking about the MICE thing, and I think you mentioned in your commentary, the April onwards we can see the MICE activity will start. So can you talk about how the inquiries are in MICE segment currently?
Yes, I'll ask Vikram. Vikram, can you explain? Vikram is our president. He's on the line, of course. Vikram, can you give a flavor on what the weddings, etc., are looking like in Q1?
Okay, definitely.
In fact, give a flavor from Q3 to Q4 to Q1.
Absolutely. So I'll tell you there are multiple segments, and within the MICE segment, let me give you a flavor of how it works in India. See, weddings happen primarily on Saya dates. And there are roughly about 100 Saya dates in a year, 100 to 120. And each wedding or each Saya date typically has 2 or 3 functions, pre and post, primarily pre, like the functions which precede a wedding. So like Mr. Keswani was mentioning, another reason why October and November were kind of slow and dull was because the Saya dates for this fiscal actually started in December. We had I think 14 Saya dates, if I remember correctly, in December alone. January had a few, but February is again got multiple Saya dates, and we already have very high. We have multiple weddings booked at all our hotels, which cater to this kind of demand. The good part is that in Q1 next year, if I look at the multiple this thing, from 42 to 45 Saya dates alone exist in Q1, and if I were to multiply that into 2, so at least 90, if not 120 functions will happen definitely. So the MICE segment is looking very promising in the coming quarter. I also want to mention another segment which has come into play now is the movie crew segment. So a lot of serials are being made for Netflix, Amazon, for the OTT segment, and they are now basing themselves in one location. They're taking bulk rooms in our hotels, and they try and this crew stays over a period of 1.5 to 2 months while the shooting is going on. So that's a new segment which didn't exist earlier. So like I said, multiple segments are playing out. Some new segments coming in. And I think going forward, this trend will only improve as we go forward.
So the two segment is driving wedding and OTT. You are talking about the new segment. What other old segment we have in the MICE thing? What are the inquiries like all the conferences, the business conferences? Are we getting inquiries for that for the maybe after 3-4 months or for May month and April month?
So I'll tell you, there are 2 kinds of, from the corporate segment, there are 2 types of MICE businesses. So the large IT companies use something called the new joinee business. So typically what happens is inductions happen for new joinees, where they book rooms and they do the inductions, where they book a lot of our hotels, especially the ones in the south, in Bangalore and Hyderabad. That segment has just started. We've just seen a very little trickle happen in one of our hotels in Gurgaon, but like I said, that segment is going to go slow even for the current quarter, and we'll probably see some green shoots only in April, May onwards. The SME segment has already started performing. They've already started booking small conferences, especially sales conferences, because in the SME segment, the one vertical which has really started traveling now is the sales vertical. Their salespeople are out in the market because they need the business to survive. So that part of the business is already coming back. And they could be booking directly with us, or they could be booking through an online travel agent.
Thank you so much.
Thank you.
Thank you. The next question is from the line of Amit Agarwal from Nirmal Bang. Please go ahead.
Thanks a lot for the opportunity. I just want to get more clarification on the cost reduction which is about. Roughly, I think the number was about 40-45 crores annually. is it possible to kind of split it up into different vertical heads, heat, light, power, employee, etc.? Some basic idea of where exactly the cost reduction is happening. I'm talking about the permanent one.
Okay, so three significant areas. Area one is staff, manpower. So I hate using cliches, but it's like they say, like some people have been saying, don't let a crisis go to waste. So what really happened in Amit, in Q1 and Q2 was that many of our hotels were, doing very low occupancies, but some hotels were doing high occupancies because of COVID and BCP and whatnot. However, because of the crisis, a lot of staff were not there. They had gone on leave or, were not physically there, unable to come. So actually at peak, we had over 2,000 employees of Lemon Tree staying in hotels of ours on a full-time basis in order to actually cater to the needs of our guests. At that time, a number of very innovative practices started in our system. So basically what we have discovered is, along with what we have done on the digital front in terms of, digital menus, and in check-in, check-out, whatever we've done, we find that our staffing requirement is significantly lower than what it was earlier. So in our normal staffing levels for our 8,000 plus rooms is one staff per room on an aggregate, which means we had over 8,000 employees. We were running these hotels, even the big hotels, at 0.4 staff per room. Sure, certain services were curtailed like spa, gym, swimming pool, restaurants and banquets and so on. But as gradually stuff started normalizing and some hotels started getting multiple types of business, especially the large gateway hotels like Delhi and Bombay, we find that we can operate at 0.75 staff per room at full service levels. So really we're talking about 2,000 staff no longer required in the system. So we have decided that obviously we are not going to fire anybody, but as it is, and there will be no backfilling. So first is staff. Now, typically, staff accounts for 20% of our revenue. We reckon we will save a minimum of 4% here. Minimum. Okay? Now, if you take our revenue, 4% of it, that goes straight into EBITDA. Second, power and fuel. Now, we decided also that since we had a lot of time, many hotels were shut, we are going to publish our first ESG report for Lemon Tree in this coming year. So we were reviewing multiple things, including our waste management metrics, our water usage, and our electricity usage. And we are now planning that by the end of the next month, at the end of April, from 5% renewable, we will hit 31% renewable for the whole group. Okay, that will lead to a significant drop in power and fuel expenses, plus whatever we have put in practice. So the power, which is typically 10 to 12% of revenue, we think we will drop by at least 2, perhaps 3%. So one is minimum 4% will go from staff expenses. Minimum 2% will go from power. Then raw material cost. We had a certain kind of food cost. We were giving a certain kind of buffet. We were offering certain types of meals. Now, with digital menus, we find we have an ability to change them on the spot based on availability of produce, freshness, and price. So we won't have a static menu. Our menu will now be a function of input cost and availability. And we reckon that our food cost, so our food revenue is typically about 100 crores. Our food cost used to be about 36%. Our new number is 29. So we reckon we'll save about 7 crores or 8 crores a year in food cost. Okay, which on an annualized basis should be about 1% of our revenue. So I'm just giving you a flavor. And of course, the 12% saving in interest. So put together, we have our minimum savings above the line and below the line will be 60 crores permanent. Interest and these costs. So those will flow straight. 40% 45 crores will flow straight to net EBITDA, and below net EBITDA there will be a further saving of about 17 crores.
One more question. I know you.
Sorry, you're not clear. I'm sorry, Amit. Can you?
Adhyana? Hello?
Yeah. Yes.
Yeah. Another question regarding the future strategy. I'm talking about not 1 year, probably 2 to 3 years down. I know you've given some of the management contracts that you've entered into, which will be relevant in FY22, 23, etc. But my question is, are you looking at any expansion of the own hotels? Secondly, you just got a new brand, Aurika. So is there going to be expansion in the Aurika brand also? Is that going to be through management contract or through own? So the key question is, any amount of own/lease hotels which you're planning in next 3 years, let's say time frame, not 1 year specifically? And if so, what's the plan in terms of either, is it going to be a higher end level or lower end level and geographically, apart from what you've got on?
Okay. So let's start with first investment. You're talking investment.
Yeah.
As far as we are concerned, we are currently the second largest owners of hotel rooms in India. We we treat leased as owned because our lease periods are 30 plus years. We already have 5,200. We are adding another 800. So that's 6,000 rooms. I think we don't want to own any more assets. In fact, the board has been discussing how once things normalize, we can actually recycle cash out of the asset side. So the short answer is capital investment, no. Next, lease. Lease is not a capital investment, though today with the new accounting standards 116, it does appear, we have to show depreciation and whatnot. But from a cash flow perspective, we find lease has been generally very profitable for us, because lease really means, in synopsis, that I take an asset, let's say 100 rupees, I pay a rental of 2 rupees, and I try and make 4 rupees return, 4% return on the asset, and I get half the profit by investing close to zero capital. So yes, we will look at leases. The best asset, however, we are looking at expanding is in the management side. So management, we are in current conversations. As you know, our current plan is that by the end of 22, we should be operating a little under 11,000 rooms, of which 6,000 will be owned and 5,000 will be managed. There may be some delays because some owners have been very cash-strapped who are building their hotels, but we will be opening a few hundred rooms in the next 6 months and another few hundred in the following 6 months. So we are pretty sure we'll be, close to 11,000 rooms on an as-is basis. But we have a pipeline of another, I think, 30, 40 hotels where there are active discussions on, which will add potentially another couple of thousand rooms in the next 3 to 4 years. That and sure, in the next 2 years, we are going to go very aggressive in the management side and try and increase this number. As far as Aurika goes, Aurika has been a super success in Udaipur. We had shut it down for a few months, but since we've opened it, it has been doing very well. But Udaipur itself has been doing well, so I don't want to, just blow my trumpet. But as a leisure property, it has done phenomenally well. And Aurika was really in order for us to expand share of wallet of customers who wanted to stay in one step above Lemon Tree Premier. So the Bombay Hotel is also an Aurika. It is, as I said earlier, the largest hotel in India. It's 670 rooms. We are building it even today, and we hope it should be ready by the end of next year. So after that, Aurika will be a management play. Typically, for everybody to know, every 1,000 rooms you manage, your share of profit based on management fees is 1/6 to 1/7 based on how you perform. So 1,000 rooms managed is the equivalent of owning 150 rooms with zero risk. Earlier in India, there were not enough branded hotels or high-quality hotels, so that even if we went all out to manage, even the largest management companies in the mid-market space manage a few thousand rooms, 3,000 to 5,000 rooms, because the total number of mid-market rooms in India is only 55,000, and the total number of upper upscale rooms is only about 20,000. So there was a problem of supply more than a problem of or desire to manage. But we reckon now we should conservatively be able to double the size of the company in the next 4 to 5 years, but we will not deploy capital. We will look at ways of recycling, in fact, our capital, which is already deployed.
Sure, sir. Just one quick question. I know you answered this before. I just wanted, you've given a very detailed answer, but if you can just help me with the number for FY22 capex and FY23 capex. I'm sorry for repeating the question.
Okay, so capex in FY22 is variable. It is a function of our cash flows. So right now, in order to see, we want the optionality or flexibility to open Aurika Bombay by end of next year. Now, what does that mean? It means that we have to have a certain minimum level of work, which requires maybe 3 to 4 crores a month now for the shell for the next 6 months. What we are basically trying to create is we are spending a minimum amount of capital, which is, I think last month was 3.5 crores, which we will increase probably to 4.5 now. So I can talk to you about capex for the next 6 months, which will be south of 30 crores. Okay?
Right.
If things come back as we hope they will, then we will accelerate deployment of capital in Aurika, Mumbai. If they don't, then that project will get further delayed by 6 months. Because what we are doing is we are trying to keep a certain liquidity buffer and seeing how much spare cash we can generate from operations, which can be deployed increasingly towards Aurika. Now, our expectation is in H1, we will do significantly better than in Q4. If that happens, then we will have some spare cash that will go into Aurika. So if you understand what I mean, I'm saying that it's difficult for me to give you a number. The right time to ask me this would be after Q1 of of this current year. Because we want to see whether cash flows pick up to the level we are expecting. In which case we'll be positive on cash. And that 250 crores will still remain as a buffer. So it's really the run rate we are talking about now. Now, if we decide that things are improved and, who knows, that in H1 this year, we hit 70% of pre-COVID, then there will be sufficient cash in our system. We will build out Mile and we will have it ready by end of next year. Suppose things are not good, then we will deploy obviously less money in Mile and keep our liquidity cushion with us. So when things improve, we will accelerate. Till they improve, we will not accelerate. Broadly, that's the thought.
That was definitely helpful. Thanks a lot, and congrats for a good set of numbers in a bad time.
Thank you. I just wanted to actually draw the attention of everybody who's listening that, from a percentage increase in Q3, it looks like we didn't do as well as others. But the reality is that we were doing very well in Q1, Q2 in occupancy numbers based on what was happening in India. And today, if you look at the listed universe, all the 4 players, their revenues are in Q3 between 60 to 69% below Q3 the previous year. We are in the middle of that. Expenses is between 20% to 60% less than the previous quarter. We are at the top end of that. Our expenses are 60% below. In terms of EBITDA, we are minus 74%. The others are between minus 80 to minus 90 onwards. Other point broadly is that if those of you who have gone through the Smith Travel Research report of Q3 in India in the list and the branded hotel segment will discover that Lemon Tree versus India occupancy was at a 30% premium. So when we did 42.4%, India occupancy was 30% in Q3. Just thought I'd draw your attention to some of these numbers.
Thank you. The next question is from the line of Rajiv Bharti from SKP Securities. Please go ahead.
Thanks for the opportunity, sir. So my question is on slide number 15 of your presentation, which talks about your Q3 occupancy of Lemon Tree Premier, which has scaled up to 56%, which is the best among your portfolio. But there has been a drop in the ARR. Have you picked up some business of late? Because you talked about that your non-COVID piece has gone up actually. So your ADRs have dropped despite your increase in your occupancy. And same thing on the same slide when you see the Mumbai asset where your occupancy has gone up to 59%. There also the ADR has dropped, and you also mentioned that in the Q4 the occupancy is at 80% or. So is there any business which you have picked up which is on the lower ADR side?
Yeah. So Rajiv, synopsis is this is all dynamic pricing. So how does pricing work? Think of it conceptually that we don't have any fixed rate business currently. Okay? And that won't come really till this vaccine is disseminated a little bit. So therefore, let's assume that will not come till Q2 next year. Okay? Now we come to these hotels. They are all getting what we call retail business. How does retail business operate? It's very simple. It's a function of customers going and looking at 3-4 hotels and then taking a call. So we are, in that sense, very, very market driven in our pricing. From a conceptual way, just think that our technology platform is the following, which is that we look at pricing of what we define as our six competitor hotels in each market. So let's take Mumbai. We scan Mumbai and say within a distance of 3 kilometers, here are 6 hotels who compete with us roughly on pricing, quality and standards. What we do is we determine in advance our premium or discount to each of those hotels. And what we do is therefore using tech, we try and say that tomorrow, say, I'm just giving you an example. Marriott in near our hotel in Bombay is at 3.5. Leela is at 6.5. JW is at 6.2. Hyatt is at this. Hilton is at this. We want to be 0.75 of this hotel, 1.1 of that hotel, etc., etc. And using this formula, we come to a price. And that's our price. That price is determined by market dynamics, not by us. And the only time it will increase is when the entire market's pricing goes up. Otherwise, there'll always be a spoiler or two who try and get business at a lower price. Which is why I said that in Q4, with an improvement in demand, pricing is also starting to get a little more rational. Therefore, price pickup will happen, and this is true for any hotel in India, only when there is sufficient demand in that micro market. Now, Bombay will start showing price pickup because as a market, it is so deep that it is among all the markets, as you notice, I mean, you can see it right here, that among all the markets in occupancy rates, occupancy percentages, it is the highest. It's our newest hotel, by the way, but it's already doing 60% in Q3 and 80 now. So that's where it will come. I can't be more specific than that because we don't determine prices. The market determines prices.
Sure, sir. So on this, the 80% number, the ADRs would be at par with Q2 or as of now, the visibility, or it will be something like Q3, 3,000 on the Mumbai asset?
Well, I don't have the numbers offhand, but the ADR of the group, because the occupancy is going up, will start improving, but there will always be a lag. There is always a lag between demand and price.
Sure.
And the sector has gone through so much uncertainty that there is naturally a hesitance to increase pricing. And that's why I said price catch up, my best guess will happen in H2 next year.
Sure. So on Aurika, the 29% occupancy, so we were shut for what period of Q3 on the Udaipur asset?
I think, no, you see, it's not only being shut, it's how many rooms are open. So see it from this perspective, that I think in Q1 we were shut completely, Q2 we were partially shut, Q3 we were partially shut. So you see Aurika is built along 3 room blocks. So sometimes we would open one block based on demand and not the other 2, then 2 and so on. So I can't give you an offhand number, But suffice to say, it was not open 100% in Q3. There were times when it was fully open when we had a wedding, times when it was half open or one-third open, and so on.
Sure. So, lastly, on your Hyderabad market. So, Hyderabad market in December, as per your data, has done 45% kind of occupancy. Some other listed player, largely Hyderabad heavy, their numbers on the revenue side is, I think, close to 45-50% for the quarter as such. Are you seeing that market picking up anytime soon?
See, we have, I think, among the largest inventories in Hyderabad, other than, I don't know, I think one other large player there is probably, there is Taj and Chalet, they both have hotels there. But we are very distributed. So we have 400 odd rooms in High-Tech City, we have 200 rooms in Gachibowli, about nearly 100 rooms in Banjara Hills, in the ownership side. So each market performed differently. For example, High-Tech did well. Gachibowli did well in Q1 because it had a lot of BCP business, but didn't do well in Q2 and Q3. High-Tech did well in Q2 and Q3. Banjara Hills, unfortunately, was a COVID hospital. And while we had a tie-up with Apollo, we didn't get the kind of business we thought. We did only about 20% occupancy there. Now Banjara Hills is picked up. So, this is a moving picture. Broadly, Hyderabad is not doing badly. It is doing as well as, we did 42.4% on full inventory. Hyderabad did 45.2%, so it did somewhat of a premium, but at a very low rate. Delhi is showing good signs of pickup. Bombay is showing good signs of pickup. Gurgaon is showing very early signs, but not good, because it is so heavily dependent on corporate that, as you can see, it did 30%. Similarly, Bangalore, which is in fact within corporate heavily dependent on IT, and IT, as you know, was a dead sector for hotels. So these will revive at different times. I can't give specific answers because I myself don't know. But broadly, I expect a bounce back in Bangalore in H1 and Gurgaon, because that's when the corporate sector will start performing. I think that's what we've been given to understand.
Sure. So one last question. On the Keys asset side, the capex number you talked about to upgrade it to 11T standard and become more remunerative. Is there a capex which is planned from the Keys side as well?
Not for this year, not the coming year, the following year.
Any ballpark for the?
Yeah, we had looked at about 1.5 to 2 lakhs a key, so about 18 to 20 crores.
Sure. That's all. Thanks a lot and all the best.
Thank you.
Thank you. Ladies and gentlemen, that was the last question. I now hand the conference over to the management for closing comments.
So thank you for listening, and everybody, and I look forward to interacting with you when we declare our next quarter, this current quarter results. Thank you.
Thank you very much, sir. Ladies and gentlemen, on behalf of Lemon Tree Hotels, that concludes this conference. We thank you all for joining us, and you may now disconnect your lines.